Great. Thank you all for joining us today and welcome to Multnomah Group's annual retirement plan and fee benchmarking webinar. A couple of housekeeping items before we get started. This presentation is being recorded. After the presentation, you will receive a link to both the recording and supplemental materials. And there is a Q&A feature enabled. So if you do have any questions throughout the presentation, please don't hesitate to pop them in there. I'll do my best to answer them as they come through, but we can certainly address anything after as well. So when we talk about retirement plan fees, I think the most common question that committees ask is a pretty simple question. Are our fees reasonable? What we see in practice is that answering that question can be a little bit more complicated than it sounds. So today I'm going to be walking through how we at Multnomah Group approach fee benchmarking, and more important, what actions we see fiduciary committees taking based upon that information. For those of you who may be less familiar with our organization, we are retirement plan consultants. That is the core of our business. We currently consult to 194 clients and over 300 plans. And that equates to just over $51 billion in assets. We're excited to be in our 22nd year of business, and today we are serving clients across 18 states. So pretty widespread. A little bit about myself. My name is Emily Zinn. I lead our vendor service area. My team is therefore responsible for record keeping due diligence, provider searches, and annual fee benchmarking analysis, which is what we're here to talk about today. In this presentation, we are going to cover why fee benchmarking matters, how to interpret the results for your plan, some of our key findings from our 2025 data analysis, and then maybe most importantly, what are the steps to consider if fees are above or maybe even within the range, peer ranges that we've identified. All right, so let's jump in. And start with why does this matter? I think there's two kind of components of this. First and foremost, we want to make sure that participants are able to keep as much dollars in the plan as possible. And so fees are a component that could erode into their asset balances. And so first and foremost, we want to make sure participant outcomes are positive and we are, not unnecessarily taking fees out of the plan. But maybe more importantly is because there is a legal component that oversees the requirement. So under ERISA, plan fiduciaries are required to ensure that fees paid out of the plan assets are reasonable relative to the services being provided. So what's important here is that reasonable doesn't necessarily mean low cost, lowest cost. Instead, it really means that you've gone through a deliberate and well-documented process to evaluate your fees in the context of the services that you're receiving. We have seen increased scrutiny from the Department of Labor and continued excessive fee litigation. So this has become an area of practice where process and documentation are especially important. Some of our plans may say, well, I'm not governed by ERISA. I'm a municipality or a governmental entity. It doesn't exclude you from this standard. Many of the state laws require a similar fee reasonableness standard be met, and oftentimes the state standard points back to ERISA as the guiding language. So from our perspective at Multnomah Group, we believe best practice is to achieve the ERISA standard for all clients, regardless of your status. So I want to have you think about your own plan. And when was the last time that you really pressure tested your fees against the market? There are several ways that we can go about monitoring fees, and really they fall on that spectrum. At one end, you have a basic benchmarking study, what we're here to talk about today. This is the easiest to complete, but also the least precise, as it's really relying on more general industry data. At the other end, you have a full request for proposal or an RFP, which is the most comprehensive approach and involves going out to market, gathering detailed bids, and really tailoring your plans, tailoring the request for bid to your plan's objectives and service needs. Um, so in this case, benchmarking kind of tells you where you are today, whereas a competitive search tells you what's actually possible. So I want to turn next to what's included in our fee benchmarking report. When we perform a fee benchmarking analysis, our first priority is to look at the core record keeping and administrative fee. So what's the cost of providing that basic service to you? Um, Secondarily, our report, and probably equally important, is how those fees are structured. So are your fees being deducted on a per participant basis, or is it on an asset basis? Or is there some revenue sharing component based on the investments in the investment menu? The structure of the fee um, can create very different cost structures to those individual participants. And so I think this report, by breaking down what's happening in the plan today, helps open the door and opportunity to discuss with your consultant what might be the best fee approach for your plan, and whether there is reasonableness in that fairness and transparency across your participants. So, for example, if a component of your fee is a revenue share model, then I may be paying something very different than you purely because of the investments that I selected. So we want to take a step back and look if that's the best process and best option for all of your participants. Additionally, our fee benchmarking report touches on something that I think often gets less attention, which is other revenue sources for the record keeper. And we'll talk a little bit more about that. And then the report also summarizes the investment management fees. So in order to make sure that we're providing you a really comprehensive report on all the potential expenses that a participant may be exposed to, we want to give you that point in time snapshot of the investment management fees as well. So as a Multnomah Group client, we review investment management fees and ensure kind of lowest share cost share classes throughout the year, but this is an opportunity to see the full picture. So there's not just a data gathering process. Part of it is is our methodology around setting up peer ranges to help with that evaluation process. So I want to dive a little bit into our methodology on setting peer ranges. The peer group range is probably one of the most important parts because parts of the process because we want to compare your plan to plans that are reasonably similar. We use proprietary market data based on both our current clients and what we're seeing in the marketplace today. Um, and ultimately, when we set the peer ranges, we set them based on our estimate of what the pricing we believe you would receive today if you were going through a competitive bid process. And so we're not trying to look too far in the rearview mirror and where fees have been, and we're certainly not trying to look at where fees might be in the future. We're really focused on what's happening today and what we're seeing today. The two primary inputs that we are using are to create these peer groups are number of participants and average account balance. So these are key factors that record keepers use when they go out to price plans. And this helps them to, they're looking at those two components to evaluate what the utilization of your plan is, and what it's going to cost them to be able to effectively service your plan. So those are the two components that we use to create the separate peer groups. And then to clarify what a peer group is not, it's not an average of those plans, and it does not account for your unique plan design features or service levels. So I like to kind of think of this as real estate comparables. If you're having an appraisal done on your house, or looking to sell and establish a price, you're looking at similar plans, but no two are exactly the same. So we want to find a reasonable range that it might fall within. Something that I think is unique within our fee benchmarking report. At least I haven't seen this in some of the others that I've seen come across my desk from other providers, is that we incorporate into our benchmarking potential other revenue sources. So one of the biggest changes in the industry over the past decade has really been fee compression overall. And so as record keeping fees have come down, providers have looked for other ways to generate revenues. I'll touch on these briefly, but if you want more information, we have separate white papers and webinars that talk specifically about these opportunities that record keepers are utilizing. So setting in to talk to each of these, I think the first and foremost, what's important is that these are not inherently negative, but they do require the awareness and oversight by the fiduciary committees. So what are we talking about with each of these 5 areas that we find most common across plans? Proprietary investments. This is where the plan includes funds that are also managed by the record keeper. So record keeper X, and you have target date series X, brand X as well. Again, in and of itself, not bad, but an awareness that they are receiving revenue as part of that component. Managed accounts, if you're not familiar with those, they are participant paid investment advice services. So effectively a robo-advisor that your participant is paying to help support their investment allocation. IRA rollovers, this is transitioning of assets out of the plan once a participant has terminated or retired. This is often to a retail IRA solution with the record keeper, and that tends to come with higher costs. The fourth one, cross-selling retail financial products. These are less easy to quantify in our analysis, because there's very little transparency from the record keepers. So most of our record keepers are kind of large retail financial institutions. And so they have other offerings, whether that's an HSA, an emergency savings plan, insurance, some other annuitization solution, other brokerage accounts, things like that. So they're looking to sell other products that are on their platform. And there's very little way to kind of translate what that means to your participants or how many people are being affected. And then finally, annuitization solutions. These have had limited usage so far, but I think this is going to continue to be an area to monitor as a fiduciary, particularly if you implement a lifetime income solution that has been kind of all the rage in conversation lately and move in market. So again, within our fee benchmarking report, we're trying to capture whether representation of where this may be impacting your plan. So we're looking at assets or participant counts, percentage of your investments that are within kind of those proprietary products to give you a representation of where a record keeper may be earning additional revenue that's less transparent to you. One of the key principles that we emphasize throughout the fee benchmarking process and conversation about fees with clients is that the record keeping fee should really stand on its own. So decisions around these committee decisions around proprietary or managed accounts or annuitization are your choice, and you have some discretion over those. So being cognizant that there are discounts associated with some of these services and products. And just to add a little more color to that context, I wanted to share briefly some aggregate data on different providers, as I think this illustrates how they may think about these other revenue sources as part of their bottom line. So this chart represents 10 providers in the industry that responded to our due diligence questionnaire. And the chart shows the percent of defined contribution plan assets that are invested in proprietary investments. That's the blue line. Assets in managed accounts, that's the orange line. And the percent of assets leaving the plan that are rolled over into an IRA at the provider is the kind of purple mauve line. And I think what this kind of shows us is that they all have a little bit of a different tilt to where their focus is. So we see provider 5 and 8 have pretty high rates of that proprietary investment management. So likely these providers are pushing or incentivizing plans to include these products in order to get that discount on the record keeping side. I think we've seen a little bit of growth in the managed account adoption. It's still really pretty low overall, but we've seen certain providers put more emphasis in marketing of that service, and we see the percentage of utilization increasing there. And then we can see that there's a couple of providers, provider 3 maybe stands out at the most of reporting that they're capturing a pretty large share of the IRA rollovers. So looking at this in kind of an organizational level, it's often very reflective of what we see down at the plan level as well. So just a little different color of what's going on behind the scenes with record keepers in terms of how they're thinking about their services overall. So to step into a little bit of the 2025 data analysis, as well as kind of maybe some highlights that we learned from provider searches in the last year. We have reviewed fee data across 230 plans this year or this past year, and conducted about 20 record keeper searches. So from those two processes, a few themes emerged. First and foremost, there was pricing stability. Peer ranges are reviewed every year and really adjusted based on what we're seeing in the marketplace. Overall, we've seen pretty consistent pricing for the last few years. I think there was a period of time where as fee compression was coming in, there was a lot of competition and fees were really compressing. But over the last couple of years, we found a little bit of equilibrium in there. So therefore, we're kind of adjusting our peer ranges tend to be more on the margin as opposed to any meaningful changes. Second, we continue to see that there is a limited impact of fee negotiations alone. So post-pandemic, or kind of in the pandemic and a little bit post-pandemic, there was much more focus on just pure fee negotiations with your existing record keeper in order to capture the benefit of that fee compression that's happened in the market. But now we are seeing that the market, a competitive market test, tends to move the needle more for your plan. So going out to bid is creating a greater fee savings than just having a conversation with the record keeper. One of the things that was, highlighted even more greatly than we already know is in a provider search this past year has to do with consolidating plan providers and the economic benefits that really can present themselves in those situations. So for plans that are in a multiple provider solution, so they have more than one record keeper, typically these are municipalities or other governmental plans. And beyond what operational efficiencies and administrative efficiencies can be gained by only having to deal with one record keeper instead of multiple record keepers, the economies of scale from a pricing perspective are tremendous. We had a client this last year that was able to achieve almost 90% fee savings by consolidating. And obviously, this has a direct impact to those participant account balances. I would say that's an extreme price reduction, but if fee negotiations haven't happened, and if there are multiple providers that are overseeing just smaller pieces of the pie, there is that compounding effect and it really adds up over time. So I think that's something that we saw this past year that really just reinforced everything that we believe about some of the benefits of consolidation from a fee perspective. We were talking about the other revenue sources for providers. They do often offer discounts on that core record keeping fee or the inclusion of certain products and services. And I think as part of the provider search process, we've really dug into what do those discounts actually look like? And so for a large plan, for example, we could see as much as $20 a participant discounted on the record keeping fee just by the inclusion of a certain product or service. So this is where we kind of get into trying to tease out how these costs may be coming back to the plan with other revenue sources and try to help evaluate that transparency within that. And then I think finally, another key highlight that we continue to monitor in the analysis process is float income. So this is income that is in transit, or sorry, this is money that's in transit from contributions or distributions that's sitting in an omnibus account at the record keeper earning interest. In today's interest rate environment, float income has become more meaningful. Based on our kind of findings of our plans, we've seen that roughly $8 to $10 per participant annually is being earned in float income. And so in our analysis report, we're looking to see whether that's coming back to the plan as a credit to use against other expenses, or whether this is being retained by the record keeper. So we're starting to see a little bit of movement in how record keepers are viewing float income and whether that's being returned or retained. Historically, most providers have been retaining that as some additional revenue on their side, cost of doing business. But we are seeing, as the dollar value has become more material, some greater interest in returning that money to the plans. So we talked a little bit about the peer group and how we think about it and set it. But I would say that kind of the key to all of this process is not the benchmarking itself, but ultimately the interpretation of the results. So when you look at where your plan falls relative to the peer group, most important question probably isn't where you fall so much as why you fall there. So below range, we've talked about the other pricing, other products or services. Um, you know, the important component here, if that's what's bringing you down below the range, is have these decisions been made independently? So have you assessed the product inclusion separately from the fee component? Within the range, great on paper, but is there alignment between the costs and services? So you may look like you're in the peer range, but maybe with conversation, there's things that aren't working well, and there needs to be further conversation. And then above the peer range, the question would be is, are there valid reasons? Maybe there's complex compliance needs, or maybe simply you just haven't reevaluated your fees in a long time. So I think it's really about digging into the why you sit in that range, um, to then turn to what are the next best steps. So, we mentioned that fiduciaries are not required to select the lowest cost provider, but need to demonstrate a deliberative and well-documented process. So if you're doing a fee benchmarking and documenting that rationale, that's a great first step. But what we don't want to happen is for a committee to become too reliant on the benchmark alone to check that box. So I might argue that benchmarking is more of a diagnostic tool, and then it opens the door for those discussions and ultimately to identify what those next best steps are. It could just be documentation. You could say everything's good, and move on. Or it could result in a decision or discussion to conduct a provider search. So at the beginning, I asked you to think about when you last really evaluated your plan fees. A provider search not only allows you to kind of pressure test the market, but it also offers an opportunity for you to evaluate the marketplace. So if you haven't been out to a competitive bid or to evaluate the marketplace in general in a long time, I think it's important to note that the market has really evolved, particularly on the technology side. So this could be an opportunity to see what else is out there, what may resonate with your plan participants. There's different looks and feels and education opportunities. So it's really an opportunity to evaluate the whole marketplace. It's not just about that pressure testing of the fees, which is important, but not the end all, right? And it may offer the opportunity to solicit more services from your current provider or another provider. So I think that's kind of what opportunities are out there, what services are out there that maybe you aren't getting because you've been in the same place for so long. And then finally, I think as we sort of said, benchmarking can be a great diagnostic tool, but doing a provider search goes more completely into filling your fiduciary duty. There continues to be more and more outside stakeholders and that are scrutinizing plan fees, and this is ultimately a provider search on a somewhat frequent basis, a reasonable basis, is ultimately the best solution to meeting those fiduciary duties. So best practice, as written by ERISA, is to solicit proposals on a periodic basis. What does that mean in practice? I would say that is probably 5 to 7 years, depending on the size of your plan. Or if something has materially changed in your plan. So as we talked about in the fee benchmarking kind of peer group setting, we're looking at participants and assets. So if something material has changed in your plan, maybe a merger, a divestiture, something that really materially changed the number of individuals in your plan or the assets in your plan, that might be a really great time to go out to bid. You could be in a different marketplace, different service tier, something like that. So it's a great opportunity to see what else is out there from providers, as well as get refreshed pricing that meets your plan as it is today. So I realize that, an RFP or request for proposal can be a very daunting project. And so here at Multnomah Group, we have a team dedicated to RFPs to conduct these throughout the year for our existing clients, but we can also do them as ad hoc projects for plans that are not yet current clients. Um, and our goal in conducting these searches is to take as much off of your plate as possible. Um, and ultimately to help you create that well-documented fiduciary process. So we have a structured process. We have a lot of information and history with all sorts of providers. And so this really helps us to be efficient in helping you to get through this process with as little pain as possible. So if there is one kind of takeaway from today, I think that it is that fee benchmarking shouldn't be about just checking the box. It's about creating that context for informed decision making. And if you haven't recently evaluated your plan, I want to say that we can offer to do a fee benchmarking using our kind of proprietary peer group ranges and evaluation method. And all it takes really is a couple of core data points from you to help you then have kind of a starting point for what are those next best steps for you, whether that is you're in a good position, whether you maybe need to evaluate your providers, or you need to go back and negotiate with your current provider. As I mentioned, we're going to send out materials to you after the presentation. We will include with that kind of a detailed about our benchmarking process. This is part of our fiduciary training program that we would do with all of our plans throughout the year. I will go ahead and leave it on the disclaimers just for our compliance folks. But if there's any questions, I'd be happy to take those now. Otherwise, we can sign off for the day. And I really appreciate your time today. And feel free to reach out to us either after the presentation for more information or contact your consultants. Great. Thank you all for joining us. Really appreciate it.